Hello everyone, welcome back to Fye Trades. Today I'm going to be breaking down the top 5 prop firm rules that are silently failing traders in their challenges. I mean, most people don't even know some of these rules exist until you get that dreaded violation email. So look, I've been trading prop firms for a while now. I've passed some, I've failed some, but to be honest, some of those failures had nothing to do with my strategy, especially in the beginning. Most of them were due to rule violations that I didn't see coming or I didn't even realize exist. And when I start talking to other traders about prop firms, I realized that this happens more often than not. Basically, everyone I know that trades prop firms has been caught by one of these. So today what I want to do is to lay down the 5 most common rules that catches out traders so you can be aware of them and you don't have to go through passing prop firms, getting a funded account, getting a payout, requesting a payout only to be told that you're not going to get that payout because there was a rule that you violated. Trust me, that is the worst feeling. So here's the thing, most traders think passing a prop firm challenge is just about having a good strategy. And yes, strategy does matter. But you know what? You can have the best strategy in the world, a 70% win rate, and still fail your challenge. Not because your trading was bad, because you didn't know the rules. Prop firms isn't just testing whether you can make profit, whether you can make 8-10%. They're testing whether you can survive their rules and their tripwires, as I like to call them. And most traders walk straight into the trap. So let me just tell you something right now. You see, when you're trading prop firms, you have no control over how they calculate their drawdown. You have no control over whether they class a news event as high impact or not. The only thing you have 100% control over is whether you read the rules or not. And to be honest with you, the first prop firm challenge I ever took, I failed it. And I didn't fail it because I lost money. I was actually in profit. And I failed it because I held a trade over the weekend. I wasn't aware that you wasn't allowed to hold trades over the weekend. So I was trying to swing trades and I ended up losing that account. Why? Because I did not bother reading the rules and the terms and conditions. Like I told you, this ain't one of them channels where I'm going to be telling you prop firms are easy, trading is easy. It's not, but it's definitely doable. It's definitely achievable. But you will fail in the beginning, but you have to keep trying. You have to stay consistent. You have to stick to your rules. And when trading prop firms, you have to stick to the rules of the prop firm. You have to know what rules you're trading under, what conditions you're trading under. So now let's start. So rule number 1 is the consistency rule. Most prop firms, especially futures prop firms, they have this rule now. So basically what the consistency rule is, no single trading day can be more than a certain percentage of your total profit. Usually this is somewhere around 30-40%, but it depends on the prop firm. Sounds simple, but here's how it gets people. Let me show you an example. Say you're on a 50K account and you need to make $3,000 to pass. You have an amazing day, you catch a perfect breakout at the Nasdaq open, you make $1,800 in a single session. To you, you're thinking, all right, I'm about 60% there. But here's the problem. If the consistency rule says that no day can be more than 40%, then you've just failed. Not because you lost, but because you won too much money. Now, most prop firms will allow you to trade through that consistency rule. Basically, at that point, you're either looking to take losing trades or you're going to keep trading until you're under that 40%. But however, some prop firms will fail you for that. They will wait until you try to take out a payout. Then they'll send you the email explaining that you failed the consistency rule. So my advice to traders is always try to stay within the consistency rule. Unless you know that the prop firm 100% will allow you to trade back down, they will not violate you later on when you try to get a payout. Sometimes there's even consistency rules when you're live. So again, you have to stay within that consistency rule. That basically just means you can't hit home runs. You can't just try to gamble on one big trading day. You're better off taking consistent small hits or base hits as they're called. So take 500 a day, take 600 a day, whatever, and get to your profit target that way. Rule number 2, drawdowns. So there's three main types of drawdowns. There's static drawdown, there's end of day trailing drawdown, and there's intraday trailing drawdown. Now what each of these means. Okay, so let's start with the first one, and probably the best type of drawdown you can ever get on any funded account. That is a static drawdown. So a static drawdown is a fixed loss limit and it does not move at all. So for example, if you have a 100K funded account and you have a $5,000 max drawdown, that means you cannot go below 95,000. However, your drawdown does not move from this 95,000. Even if you make 110,000, even if you make 120,000 or 130,000, your drawdown still remains at 95,000. So basically, your drawdown gets bigger as you make profits. So that is the best type of drawdown because it stays at a set figure and it does not move no matter what happens. So with a static drawdown, starting balance 100K, drawdown limit 95K, your account grows to 110,000, your drawdown limit still stays at 95K. It does not move. It's the easiest type of drawdown. It's the safest type of drawdown. And it's the best type of drawdown to build a large buffer and to take bigger trades. You can increase lot sizes and contract sizes as your drawdown increases because you have more room for risk. Okay, so now the second type of drawdown, which is probably the most common one, especially on futures prop firms, is end of day drawdown. So what end of day drawdown means is that your drawdown limit is only calculated and updated at the end of the trading day. So it does not move up whilst you're trading. It will only move up at the end of the trading day if you are in profit. So for example, let's take that same 100K example. You have a 100K funded account and you have a 5% end of day drawdown. That means your starting drawdown is 95,000. So you cannot go below 95,000. Now, say on day one, you're trading your account balance and you make a profit and your account goes to 103,000. Now, what happens is at the end of the day, your drawdown will get calculated. So now your drawdown for the following day, instead of staying at 95,000, your drawdown will now move up to 98,000. So the following day, you will start trading with your balance at 103,000, but your drawdown now is at 98,000 because on the previous day your drawdown was at 95,000, but now because you've made $3,000 profit, your drawdown moves up by 3,000. So your drawdown is always 5% away from your current balance if you are in profit. So say for example, you now start trading on day two, your balance is now 103,000, your drawdown limit is now 98,000. If you lose money and you finish the day with 99,000, you're still safe because your drawdown is 98,000. However, if you go below that 98,000, you lose your drawdown. So the difference is with a static drawdown, your drawdown will still stay at 95,000 no matter what happens. Even if you make $20,000 in one day, your drawdown will not move up. Whereas with an end of day drawdown, your drawdown will always move up if you make profits, but everything is calculated at the end of the day. Okay, so now let's talk about the last and final and probably the worst drawdown type. It's the intraday drawdown. So with this type of drawdown, basically your drawdown moves up in real time whilst you're trading. So whereas static drawdown never moves, end of day drawdown is calculated at the end of the day. This drawdown is calculated in real time whilst you're trading. So let's take that 100K example again. So you start off with a 100K account. Your drawdown limit is 95,000. So during the day you're trading, you have a good trade. You make $3,000. Your account goes up to $1,300. Now what happens? Even though you're still in the trade, your drawdown moves up whilst you're making profit. So now your drawdown has moved up from 95,000 to 98,000 because you are $3,000 up, even though you haven't closed the trade. Now, say all of a sudden the trade starts going against you, and now your balance comes down all the way to £97,900. Guess what? You've breached the drawdown. Even though the trade hasn't closed, it doesn't matter. You've breached the drawdown because at some point it went below that 98,000, which was your new drawdown. That's how intraday drawdown is. Very tricky. So with this type of drawdown, I always advise to aim for one-to-ones or use a trailing stop loss to lock in your profits, so you don't allow trades to come back against you because your drawdown moves up in real time. So if you're up 3,000, your drawdown moves up 3,000. If at any point price comes back against you by 5,000, you would have breached the drawdown. Even if then price goes up and you close the trade in profit, it doesn't matter. The fact that at some point, even if it was only a second, you would have breached your drawdown whilst you was in the trade. I advise you one static drawdown. They're not very common, especially for futures. End of trade is common. Intraday also, if you know what you're doing, if you know how to take profits, lock in profits. You can also pass. I've passed intraday funded accounts before, but it was by locking in profits, taking small. You're basically taking small hits all the way through. You're never holding your trades and allowing it to come back against you. So there's a strategy to do it, and it can be done. But for new traders, I would advise end of day drawdown, or if you can find a static drawdown, it's even better. So rule number 3 is news trading. Now, this is another one that catches out a lot of people. And I have to be honest with you, I've been caught out by this before. So most prop firms actually ban you trading the news. So events like NFP, FOMC, CPI, those are usually the main ones. So the problem is each prop firm has a different way of approaching this. Some prop firms will allow you a 2-minute window before and after the release of the news. So say news is coming out at 2:30, you can trade up to 2:28 and you can trade from 2:32. Some prop firms will allow you to trade through news, but you cannot modify your position. That's how I got caught out. So basically what happened is I was in a trade. I knew that you couldn't trade through news. So what happened? I was in profit. So as the news was about to start, I moved my stop loss to break even because I'm thinking, okay, when the news starts, if the market suddenly goes against me, at least I'll get taken out at break even. But what happened? The market went in my direction, but because I moved my profit, my stop loss to break even, that was counted, that particular prop firm saw that as trading during the news. So you cannot even move your stop loss, you cannot move your take profit. Like you cannot touch anything during that window. So for some prop firms, it's 5 minutes before and 5 minutes after. Some include medium impact news. So instead of the main 3 that I just named, NFP, FOMC, and CPI, some will include yellow folder news. So you really, really have to read into this and make sure you know exactly what the rules entail. Me personally now, I just don't trade news at all. It's not even part of my strategy. So I will close my trades either well before news starts, maybe like 15 minutes, 20 minutes before news, or sometimes I'll wait till after news, maybe half an hour after the news, then I'll look for a trade. So I'm not really affected by that so much nowadays, but it is a big one. NFP, every firm restricts it. Like those 3 that I named, every firm will restrict them, but then you have to be aware some firms do restrict other news, which is known as yellow folder news. So my advice, before every trading day, go on Forex Factory, check the calendar, check what news is coming out at that day, and mark it on your chart. Put something on your chart to mark your no trading windows, and do not trade during those windows. If you're already in a trade well before that, you choose to leave it to ride out through the news, that's fine. But do not modify your trades, do not add to your position, do not move your stop loss, do not do any of that. Okay? So rule number 4 is weekend holding and overnight rules. Now for futures prop firms, that does not really affect you that much because you close most of your trades by the end of the trading days. Some firms will allow you to hold trades over weekends, but most won't. Some will allow you to hold trades overnight, some won't. So there's 2 traps here. Basically, the first trap is the hard band. This means that you cannot hold a position over the weekend, period. And if that happens, you've breached your account, you've lost your account. It doesn't matter whether your trade was losing or whatever. The fact that even if your trade wins, you've breached your account, you lose your account. The second trap is the margin shift. So what happens is some firms will let you hold trade over the weekend, but they can change the margin requirements at the market close. So even if your position was okay before the market closed, because of the new margin requirements, and if it's a large margin requirement, that can breach your account and you can end up losing your account. So just make sure, if you're someone that swing trades and you like to hold your trades over weekends, get a swing trading prop account or find a prop account that allows you to hold trade over weekend, and also check the margin requirements and everything. Like, you have to do the research and know what you are trading. If you're trading futures, then you shouldn't be holding trades overnights anyway. Most of the time you will open and close your trade within the same day, so that shouldn't be a concern. So let me show you something. I pulled up the rule books from a few of the major prop firms, and as you can see, they all have these rules, but they're slightly different. For example, this prop firm has a 30% consistency rule, but this one has a 40% consistency rule. This prop firm uses trailing drawdown based on intraday. This one uses end of day static drawdown. These differences are massive. So if you're just trading the same strategy across all prop firms without knowing these differences, you will get caught out. Like, you have to adapt your strategy to each prop firm that you're trading. Okay. Now, of course, it's not going to be like this for every firm. Some firms are more lenient than others. Some don't even have a consistency rule in their funded phase. Some don't have consistency rules during their challenges. Some use static drawdown instead of trailing. And some of the new prop firms are actually simplifying their rule books to make them more trader friendly, because the prop firm space is getting competitive. So prop firms, especially the newer ones, they're trying to entice traders by making the rules more friendly. But the risk with that is, with new prop firms, you don't know whether they're gonna pay out. They haven't established themselves. You don't know what sort of funding their house have. You don't know how liquid they are. So with me, I will always go with the major prop firms, and I will be doing a video to show you exactly which prop firms I trade, which ones are almost guaranteed payouts that you won't have problems with. As long as you stick to the rules, they will pay you out. So another rule that catches people out is the inactivity rule. That is rule number 5 that catches people out. It's the inactivity rule. Some of these prop firms, they require you to take a trade. Some will be once every 30 days. Some will be once every 14 days. So, because what happens, this is another thing that caught me out. So the first time I was trading, I think I was trading three combined accounts, and I passed one. And when I passed it, I said, you know what, I'm not going to touch it, because, like, I've had it. The first time I passed an account, I got excited, which happens to most traders. Then you start seeing the real money on the screen, and then you want to make big money, and then you start doing things that's not part of your rules. Greed sets in, you start over trading, and you end up losing the account within a day or two. So this time I thought, you know what, I've learned from my previous mistake. When I pass, I'm just going to leave the account. I'm not going to trade it straight away till I'm emotionally settled. So what I'm going to do, I'm going to carry on trading my other accounts, try to get those funded. So whilst I was concentrating on my other accounts, I left the funded account. I did not touch it for 30 days and I ended up losing the account because of that rule. So just know that once you have a funded account, most prop firms will require you to take at least one trade every 30 days. Some it's even every 14 days. So make sure you look into that rules and you know exactly what you're trading. This starts from the day you pass your challenge, by the way. It's not the day you get the funded account, it's from the day you pass your challenge. So make sure you take that into account. If you pass your challenge today, it starts from today. Even if you get your funded account tomorrow or the day after tomorrow, it starts from the day you pass your challenge. So yeah, just make sure you take your trade within that permitted time. Also, there's things like minimum trading days where you need to trade a certain amount of days. So the point of this is do your homework, read the rules, and do not just have one strategy that you think you can trade across all prop firms without altering it. Each prop firm is going to require a slightly different approach. Even if you use the same strategy, the approach might be slightly. For one, you might be able to hit a home run pass in one day. For the other, you might have a 40-50% consistency rule, so you need to take 2 free trading days. So just make sure you're aware of all of that. Like I told you in my first video, the only thing you have 100% control over when you're trading is how much you lose. So make sure you know the rules and monitor your risk. Okay, so that is it for this video. I hope you find it helpful. If you found it helpful, if you like the content, please like and subscribe, and I'll see you on the next video. If you have any questions about any specific prop firms, any rules or anything you're not clear about, drop them in the comment section and I will make sure I answer to everyone.